Welcome to the Big Mike Fund Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in. Because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund Podcast. I'm the Big Mike.
Mike Zlotnik, and today it is my pleasure and a privilege to welcome Jeremy Dyer. Hi, Jeremy.
Hey, Mike. Thanks for having me.
Thank you so much for coming on a podcast. Jeremy is a founder and managing partner at Starting Point Capital. Also is VP of Capital Formation at Rise 48 Equity, host of the Freedom Point podcast, and author of the book called The Fundamental Investor. Once again, thank you, Jeremy. But before we go into your career, things you do, tell the audience a little bit about you, where you live, your family, anything you want to talk about. I like to use these terms: dogs, cats, pets, kids, anything you want to talk about, family. So
I appreciate that, Mike. I live in Lake Elmo, Minnesota, which is a suburb of the Twin Cities of Minneapolis. I'm a husband of my wife, Marlene, for the last 21 years. Also a father of four homeschooled children. I'm a limited partner investor in over 30 deals as an LP, recovering fix and flipper, so to speak. Also a retired marathon runner and current youth hockey coach.
Wow, that's a great short history of Jeremy, and you have a wonderful family. You have a blessed family. That's great. And I guess marathon runner. You must be quite an athlete. That's not easy. So,
yeah. Well, if you caught what I said, Mike, I said I'm a recovering marathon runner.
What does it mean, recovering marathon runner? You used to run a lot. Now you're taking it easy.
Yeah, that's right. So I was able to make it up to 20 different marathons, ran in multiple different cities across the country. So had a lot of fun back in those days. But now with four kids, most of which are in kind of those teenage years, it makes it a lot more difficult now to balance, the long distance running with, quote unquote, running the kids around, so to speak.
I know this story really well. I have four kids too. I have four monkeys and a cat. Well, I have a real cat, but four kids. So I know the drill, teenage kids, and you have to be full-time daddy. We have a wonderful family. All right, so let's move a little bit beyond that. So let's talk about your business. So what do you do today? What's the biggest, let's just call it, opportunity that you're working on today? Let's start there.
Yeah, no, that's great. I appreciate the question there. So just to kind of give you a little bit more background on myself. So I'm also a recovering sales professional in the technology space for over 2 decades. I was very blessed in my career to be able to be in a position by the time I was just 24 years of age to have my dream home completely paid off, had a couple of children, couple more on the way, 40-foot RV sitting in the driveway, maxing out the 401k plan, trying to find the next, Tesla, Facebook, Apple stock, so to speak. My wife was able to exit the W-2 back when she was just 23 years of age. And I'll be honest, we got a little bit bored in our mid-20s. And we decided to start up a real estate company, which was primarily a fix and flip company, which was designed obviously to buy distressed single family assets, essentially provide renovations, turn those assets over, and hopefully walk away with enough profit to want to do it again, right? And so that business was going well for us. The challenge is just a few years into that venture is when my wife and I decided to double down on kids, and we went from 2 kids to 4 kids. And at the same time, I was still crushing, my day job, crushing the commission check, so to speak. And it was time for me to decide to step off of, riding 2 horses at the same time. The horse that we decided to step off of, was the active fix and flip business. I decided it was best just to focus on continuing to crush the commission checks, while at the same time, being a good husband and being a good father and, community leader, servant, so to speak. And so at that time, this is now 2015, Mike, we decided to passively invest into real estate syndications. Back in that time period, I had no idea what the word syndication even meant, other than it was just simply a group investing type strategy. I was able to diversify, into, Main Street real estate investments, outside of traditional Wall Street investments. And I wasn't the guy that had to evict, tenants and swing hammers on the evenings and weekends. And so we started investing in syndications back in 2015. And now if you fast forward from 2015 until today, we're in 31 investments as limited partner investors. I'm in 5 investments as a general partner. And my company, which is Starting Point Capital, merely exists for a couple of reasons. Number one, Mike, is to educate investors on the benefits of passive real estate investing, one. And number two is to use our leverage of a community of investors to come together in order to properly vet out deals, sponsors, and ultimately give our investors a better return profile into the deal, given the leverage of investor capital that we deploy into each individual opportunity that we source.
That's really cool. That's a great story. From fix and flip, going back to the corporate job. And are you still holding the corporate job, or you're done with that, and you pretty much have been just passive investor, and then you said you are a GP or a co-GP on 5. Just curious where you're at today.
Yeah, thank you. Yeah, so I've been very blessed in order to be able to step off of the W-2, hamster wheel, so to speak. I consider myself to now be a corporate refugee in large part. And, why was that possible? Well, it was primarily possible because, very early on, we got smart about our finances, right? Certainly we chose not to spend 100% of my commission checks and bonus checks. Instead, we chose to, live a more balanced lifestyle, while at the same time, being diligent about pursuing investments. And it wasn't just, Wall Street investing. It was also investing in Main Street businesses, that produce, regular, consistent cash flow. So it just got to the point with my wife and I specifically, where that dependence on the paycheck continued to get less and less over time, right? I was no longer dependent upon a salary. I was no longer dependent upon, hitting 100% of my, month, quarter, or year in order to achieve or earn a paycheck, right? And so, now I tell potential investors and existing investors that every month I receive 31 direct deposits into my bank account because I'm in 31 investments that produce, regular, consistent, cash flow. And that doesn't even include, the equity upside that we receive, and those investments go full cycle. And it also doesn't include the fact that there's, significant, tax benefits as well, being an investor in real estate.
Yeah, I appreciate that explanation. So it makes a lot of sense. So you give up on a full-time job to be a passive or semi-active or maybe even an active investor. So what are these syndications? I'm just curious. Are they all multifamily? Are they all there's some storage, industrial? Just curious what gave you the foundation for financial freedom?
Yeah, a great question. Well, I will say multifamily was certainly the gateway drug that led to the other types of investments that I made. But, of the investments that I've made historically, including deals that have gone full cycle, deals that I'm currently in today, about 80% of them are tied specifically to multifamily, the majority of which have a value add, component to them. Of the other 20%, it's in other asset classes like self-storage, assisted living, flex office, retail, just to name a few.
Yeah, I appreciate that. And we're recording this middle of October 2024. So I just want to make sure I'm hearing it right. You have 31 syndications, and when were they started? and they're still paying distributions? Because as you know, number of deals in the last couple of years have had some challenges due to the higher interest rate environment. I'm just curious, what kind of deals are paying like clockwork, and if they were value add deals versus sort of a stable fixed rate, fixed income type of deals. Just talk a little bit about that.
Yeah, it's a great question. So my investing really was in a pause in the year 2000, 2021, and early 2022, fortunately. Okay. I didn't make a lot of investments during that particular time period. I had invested in a number of different angel type investments during that time. We can get into maybe a little bit more of that, later or off camera.
High tech angel, or is this business angel?
Business and high tech both. So, my investing oftentimes is to really consider, what's next on the landscape, what problem exists for the consumer today that at some point in the future somebody's going to be looking to solve. Okay. Certainly biomedical, is a good potential angel type investment, to make. There's a company out there that exists today that has successfully mapped all elements of the periodic table of elements using radio frequency. So now they can detect inside the body over 220 forms of cancer without any invasive, surgeries or operations. Obviously, it has a lot of use cases when it comes to, weapons, for example, detecting explosives, narcotics, those types of things. Beyond that, the other big problem that I know exists out there today is affordable home and affordable housing. The way that we, manufacture homes using traditional, cement and sticks, right? There has to be a better way. If we can assemble a vehicle on an assembly line in less than 2 minutes in Detroit, why can't we do the same? Why can't we apply the same types of principles to how we manufacture homes? Okay. And I'm not talking specifically about ADUs that are constructed that look like shipping containers. Okay. I'm talking about, 9.5 foot ceilings, 20 by 20, boxes that could be stacked on top of each other, side by side, et cetera. So my interest during that time period was very laser focused on trying to find out what is the next major disruptor out there, whether it be, medical or be housing or some other, types of angel investments that I made as well. So I was largely able to get past, some of those challenges. So fortunately, the investments that I'm in large part, are paying regular, consistent distributions to investors. And I haven't had any deals, so to speak, at this point, where I've had to introduce additional capital call into the deal to keep it afloat.
That's great. That's the words of the wise, right? You figured out kind of the market timing, and you stayed away from new multifamily deals at the peak of the market per se. So if you did that, you probably are in great deals that were bought deep enough, long ago enough that these deals are still probably pretty good shape. Although if the rates continue to stay higher for longer, for too long, we're obviously going to have more maturity wall and other fun things, but we'll see. The Fed has started to cut. So that's actually great to hear. So you ventured into biotech, you ventured into manufacturing of, I guess, new affordable houses. They're manufactured homes, right? There's a whole industry that builds the house somewhere else, and then they bring it to the lot, and then they kind of bunker it down, right? That whole industry exists too. So what opportunities ahead? If you've had your foresight that the market was going to turn in basically after the Fed started to hike rates. So where do you see good opportunities today? Fed started to cut, right? Which is welcome news for the entire commercial real estate industry in general. It's good news for high tech too. High tech doesn't like high interest rate environment. So where do you see best opportunities on a forward basis as far as your view of the world today?
Yeah, no, I appreciate that. And obviously today is a good point. We're in Q4 of 2024, so we're not quite sure what the next black swan event is going to look like. And certainly I haven't always been, as successful as maybe others at trying to catch the falling knife, so to speak, right? But in 2023 and 2024, I personally have been very bullish on investing specifically in multifamily. The deals and opportunities that I see personally come across my inbox that I've chosen to deploy my own capital into, Mike, have, for the most part, those deals are not penciling unless there's some major distress involved. Okay. When I say major distress, obviously, for most operators that are distressed within the last, 12 to 24 months, it's largely been on the financial side, right? To your point, the historic rise in interest rates, have made it difficult depending upon how that debt was structured, the amount of liquidity, the operator raised on the front end for reserves, right? Their ability to execute, the business plan, on time and on budget, right, are incredibly important. And the truth is that there was a lot of sponsors that over leveraged. It felt a little bit like the .com days back when I was in college, right? Day trading stocks and trying to find the next penny stock to ride it to the moon. It felt a lot like that back in 2021. Okay. When everybody was running into the fire, we should have been running out of the fire, right? Valuations were high, cap rates were compressed. There was deals that I know sponsors in the space were putting in an offer, and there was 50 other offers and they were 17th in place. Well, at that point, something's got to give. And what gave is that you got sponsors that were in the space that were chasing after, the acquisition fee. They were chasing after the AUM. You had sponsors in the space that didn't even need to execute any part of the value add business plan, and they could just ride it out another 6 or 12 months, bank on natural or organic appreciation occurring during that time, and essentially flip the property without actually executing, any element of that business plan.
Well, that was a great theory, unfortunately. How should I put it? This was the peak of the market, and it was hard to detect, and the money was chasing deals, and yes, a lot of, let's just call them aggressive underwriting, overpayment, and no need to be a good operator. And a lot of those deals have crashed hard, right? So today, I do concur with you that markets have corrected. Many markets have corrected, and valuations appear to be healthy on a relative basis, but the interest rates are still high. We just started to see rate cuts, and it'll take a while for Fed to bring those rates down. So where do you see transaction volume is very, very low, as we all know. Do you see these great opportunities happening in any kind of volume? Because essentially what you just described is an environment where fundamental multifamily is still solid, but the distressed sellers, liquidity crisis that they just running out of cash, they have to sell because they can't raise cash. So you're seeing enough of these deals, where these deals are, what parts of the country, what kind of discount are you getting to the, I guess it's all relative. How do you know it's a great deal? If you go look at the peak pricing from a couple of years ago, yeah, it's 25% discount for sake of the argument, maybe even higher. But it also depends on the kind of asset, right? Really high quality assets don't trade at that big of a discount. So it just talk a little more. What are you seeing today? Specific examples, just a little more color on that front.
Yeah, no, I appreciate that. You do a really good job asking multiple questions all in one. So hopefully
I'm trying to overwhelm you. At least give you enough questions so you could pick which ones you want to answer.
Yeah, there you go. I appreciate it. I sound like a politician now, right? So, no, in all fairness, the types of opportunities that we're seeing out there, while they are, like finding a needle in a haystack, okay, we may underwrite 100 different properties before we even take, one of those under contract. Our buy box is fairly narrow. Okay. When I say our buy box, we're traditionally looking for assets that were built 40 years ago, that have 100%, classic interiors. They're all vintage units, right? we're coming into those opportunities with the plan to fully renovate 100% of those interiors as part of our value add, business plan, bring in our vertically integrated property management company, vertically integrated construction management company, and really try to rip through those renovations in an accelerated manner. Again, on time and on budget, because we control all elements of that value add business timeline from acquisition all the way through disposition. Okay.
What markets?
Yeah, a great question. So right now we're really primarily laser focused on the Dallas-Fort Worth market. We do like Charlotte, North Carolina, and some sub markets out in that area as well. And then lately we've been, I would say, dating, or maybe courting is the right word, some markets in North Florida as well. To your point, the types of opportunities that we're primarily seeing, again, that are on the distress side, can be anywhere from 20 to 30% below what those properties, did trade for or were trading for just 24 to 36 months ago. So certainly there's some opportunities to get these properties at a better basis. But what's also interesting to note out there is that one other reason why transaction volume, I believe, has been, suppressed over the course of the last 2 years is because there are a lot of operators in the space today that, quite frankly, have been nervous to transact volume. And why they've been nervous is because they weren't maybe sure that they could raise capital from their investor base, that they just recently had to go ask for some additional liquidity in the form of a capital call or a cash call, because the debt service coverage ratio has maybe slipped below 1.25 or something like that. And now the bank comes knocking saying, you need to pump some additional liquidity into the opportunity, or you obviously run the risk of a potential, foreclosure. So the truth is that there's a lot of best-in-class operators even out there today that I think have been sitting on the sidelines, not just because they weren't quite sure, what was going to happen in the wake of the Federal Reserve Bank, historically running up interest rates and the cost of debt, but it's also because some sponsors in the space, quite frankly, have a reputation crisis on their hands. Okay, they have a brand that they need to rebuild again, and they just weren't confident in their ability to raise enough equity in order to be able to, acquire that next property.
Very true. It's exactly the observation. Not some, a lot of sponsors. So it's unfortunately the entire value add industry got significantly hit with higher for longer rates because value add industry borrows on a floating rate debt, and rate caps expired or expiring. So capital calls, additional capital injections, member loans, mezzanine debt, preferred equity injections, all that is absolutely true. I mean, we play in the space quite a bit, and we've been providing these mezz loans on many deals they're still pencil well, of course, but it's very difficult to go look at new deals when you're trying to stabilize a lot of existing deals. So very, very true observation. Not only that, your investors, the liquidity is stuck. So today, when things transacted, you can go buy a new one. When you got a sale, so it's the chicken and the egg problem. When sales are not happening, it's harder to buy, and the investors are not necessarily throwing more money into something where they already have a lot of money stuck. It's a fundamental shift problem. You got to go find a whole bunch of new investors that don't have anything today, and you convince them to be like Warren Buffett says, be greedy when I was fearful, be fearful when I was greedy. A lot of people are fearful today, so the idea is to bring the greed into the ecosystem, and we gotta, as a whole industry, we gotta bring new dollars that has done really well in the stock market, Bitcoin. I don't know what else. Those assets have heavily appreciated, and they're sitting on, let's call it, non-diversified portfolios, heavily concentrated portfolios. So logically, these folks should be good candidates to write a check, but they don't really know the industry. They can only hear some of the tough stories. So it's one of these educational necessities that if you can get them on board, should be able to transact more. But the observation is exactly accurate, because previous money is stuck, same ecosystem of existing investors. How do you get more money from them? Well, maybe a few, but 90% of them are nervous about, are they going to get their money back? When? How much? So, but agreed, opportunities ahead today are phenomenal. Certainly like that Dallas market, certainly like you said, Charlotte, I think. So Charlotte is a great market. North Carolina in general is a good. These are great growing, demographically improving markets on a long-term basis. Jobs are going in. So I couldn't agree with you more that these are solid markets for sure. So on that topic, how are you raising capital today? Because it's tough. It's tough, and do you have specific deals? And I can tell you this, just my observation. When we see new deals today, I certainly call a whole bunch of other fund managers where we could raise the capital ourselves in the past. Today, I got a call, get the consortium of 4 people or 3 people to get the forces together to have confidence to be able to get the capital, because it's gotten 3-4 times harder, if not more. I'm just curious, how are you able to get through these opportunities confidently so you can actually sign the contract or commit to getting the check or significant check into the deal?
Yeah, no, it's a great question, Mike. And I kind of joke with people sometimes that I actually started raising capital 25 years ago, even though technically I've only been partnering with investors now for the last 2 years. Okay. And you and I both know this, but your reputation and your own personal brand and your own personal stock price is everything, right? And so the truth is that most of the investors that I have brought into, our investment projects are largely people that have known me personally, whether it be 5 years, 10 years, or 2 decades, right? These are investors that will partner with me on investment opportunities just because I'm doing it. Okay. They may not even understand fully, what it means to be a passive limited partner investor in a real estate syndication, right? They might not even be able to, say it that eloquently as an example, right? They maybe haven't done their own due diligence on the opportunity, but maybe they've got 50 or 100K, in dry powder sitting on the sidelines, and they just know they want to diversify outside of Wall Street and into Main Street, and they know some of the benefits, right? So why I've largely been so successful is because of my background, okay? My reputation in the business, my connections, my ability to garner referrals from existing investors. But what keeps people coming back, because the majority of our investors don't just invest one time and they're done, okay? These are investors that will dollar cost average, so to speak, or they will, drip into a few different opportunities each and every year. Okay. And why they do that is because of our ability to produce what we say we're going to produce. Okay. Whether it be when you can expect your first month's distribution, what you can expect your year 1 cash on cash return to be, what we anticipate, where we're going to be after 12 months or 18 months in the renovation efforts, how we communicate, to our investors on what frequency and how transparent are we? I mean, we're giving our investors access to the same information that the senior lender, who's the largest investor in these opportunities, demands. So we're not just talking about what the renovations look like and giving you a side-by-side comparison of the before and after. We're giving you access to the balance sheet, the bank statements, the general ledger, right? You have access to the very same information that we, as people on the general partnership side of the equation, have access to.
Yeah, I appreciate that. That's transparency and openness and great communications are critical. And the fact that you're able to hit projections, especially in the last couple of years, maybe you stayed out of them in the past, but it has certainly been a lot easier. The last few years, of course, a lot of projections have not held up, and the game's got a lot harder to get the same investors to continue to trust the sponsors. So I understood and agreed. It's all about reputation. It's all about delivering on expectations. But as I said, it's gotten way harder. So if you're one of the few who's we stayed out of trouble, market conditions, and have done really well on the deals that you picked. That's so much more power. So besides multifamily, what else you see today? I'm just completely acknowledging the fact that I'm in agreement. The whole industry is singing the song today that if you can buy today, it'll be so much easier when the rates are lower. That's pretty obvious. Capital raising is still ultra tough. And what other great opportunities you're seeing today besides multifamily? You seeing anything else in storage? Seeing anything else? So other obviously sectors, other locations, other deal flow, and it sounds to me again, you and I have somewhat similarity where you're not actively necessarily running these deals. You're co-GP. You're partnering with people who are operating the vertically integrated folks. The business is all about building these strong partnerships. So you're finding new great partners today, or you're still working with the same folks you worked in the past, just more of new deals?
Yeah, so there's three investment sponsors that I primarily have aligned with in raising capital for their deals. Now, I don't always partner with them on every single, deal and opportunity, right? Capital raisers typically get to that point of saturation with their investors where, maybe their investors need to build up a couple more, commission checks or quarterly bonuses in order to be ready to, invest into your next opportunity, right? I'm not an expert in other asset classes outside of multifamily, but I've personally invested in oil and gas deals before, ATM funds. I mentioned some of the other hard asset classes that I've personally deployed my own capital into, mainly self-storage, assisted living, flex office, retail, et cetera. But the majority of our investors that invest through Starting Point Capital have never invested in real estate before. And so hence the name Starting Point, right? We're giving your higher net worth individuals, your accredited investors, or maybe almost accredited investors, that opportunity to diversify, outside of Wall Street into Main Street, while also encouraging them, to deploy a strategy where they diversify over multiple different properties, maybe in multiple different geographies, maybe with multiple different investment sponsors, right? So we're giving them that ability to diversify, but while also encouraging them to consider partnering with other operators with different asset classes that we may or may not choose to partner with them. So I'm all about diversification, but at the same token, I firmly believe that all investors, if they're going to invest in their first private placement and they've never done it before, a good place to get started and to really learn about this type of an investing strategy is really in the multifamily space.
Yeah, that's a great view of the world. You're helping, I guess, starting investors, which is basically, in many ways, is the best place to be. Once you're dealing with experts, once you're dealing with the very sophisticated folks, they have very different view of the world in essence. So, and multifamily is a great space in general. We do need more affordable housing, and it's the problem you mentioned. So that problem will continue to be here for a long, long time. The asset class is still fundamentally very solid. So don't necessarily be a jack of all trades, be a master of one, right? And you're a master of multifamily. I concur with you. And we've done, through our funds, we've done investments in many other strategies, but we still love multifamily. It is one of the most fundamental asset classes. So do folks invest with you through a fund, or you have individual deals? Just curious how you work with folks on various deals.
Yeah, we can actually partner with investors in both ways. So we can invest, partner with them through a fund type of investment strategy, which is actually what the majority of our investors prefer. Why they prefer it that way is because we're able to negotiate a better equity split with the sponsor when that deal goes full cycle than what they would be able to get on their own. Of course, there's an arbitrage there, and we split that arbitrage, with our investors. So that's how we're able to legally be compensated through the capital that we source for these opportunities. And we're also able to project to our investors a better return profile than what they would get if they had invested as a retail investor directly into the sponsor's deal. But there are other opportunities that exist out there where we can partner with investors, under more of a co-GP, type of an arrangement where that investor is investing directly with the sponsor and directly into their deal versus going through an SPV or a fund of funds type structure.
So, Starting Point Capital, you're on a fund of funds, you're on a multifamily fund, or you just do one-off SPV syndications, essentially. I'm just curious how you're doing it, because what you described is sounds to be like maybe you have one of those, or maybe multiple strategies. So is there a fund essentially where they just subscribe to your PPM and then you invest into multiple deals, or you have one-off PPMs every time you have a deal?
Yeah, it's a great question. So it's definitely done under an SPV. And so we establish a fund, single fund for a single investment asset or property.
So it's a syndication, right? I mean, you're calling it a fund, but it's really, in my head, fund means many assets, many investors, right? Syndication, single asset, multiple investors. Syndication could be two assets, right? I mean, this certainly can happen.
Yeah.
So you're doing one-off deals. You're not running just a evergreen fund that just keeps doing things over time.
That's right.
Okay. All right. So what's the best way to reach out and then ask you about, you have a good book to recommend? You have a good just general advice?
Yeah, no, appreciate that. So folks, if they're interested in connecting, can find me on LinkedIn. I'm relatively active there under Jeremy Dyer. You can also hit up our website at startingpointcapital.com. Again, that's startingpointcapital.com. When it comes to book recommendations, historically, I've been a very big fan of The Hands-Off Investor by Brian Burke. I had Brian on my own podcast, which is called the Freedom Point Podcast. I think it was maybe episode 46 or 48. You can check it out there. And then on December 1st, depending upon when this podcast airs, December 1st of 2024, I will be launching my book, which is called The Fundamental Investor. Again, The Fundamental Investor.
Very cool. I appreciate you sharing and your website, and good luck with the new book. Should be pretty cool. I'm working on a new book too. It seems to take forever to finish. It's always difficult to get the book to look perfect, and no matter how much you do, if you come back to it, you can always get it better, right? So
Mike, when I hired a publisher, they told me that it would take 12 months. And I said, no, it'll take me 4. Well, it's going to be about 14 since I started.
Well, it is a wonderful journey. And I'll tell you this, all this book business, it's almost like this. It'd be great to just publish a book that is completely changing as you revise it. Like literally you buy, of course, first edition, second edition, third edition, looking for technology you buy a book, and then the book by itself updates as you want to update the content. But that's why they have first, second, third edition. You gotta at some point go with that version and see what happens next. So
that's right.
Again, thank you for sharing. Any other quick comments, thoughts before we part? I appreciate your wisdom. Wish you good luck with the book, and hopefully find some great deals. It's been an interesting maybe we live in interesting times, that we do.
Yeah, Mike, no, I really appreciate the opportunity to be a guest on your show. Thank you so much. And hopefully we were able to provide your listening audience with some value today.
Certainly have. Thank you, Jeremy.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.